Welcome to our discussion of Chapter 9, Analysis of Financial Statements. Managers use financial data to make decisions for the companies they manage, and investors measure the results of the company's operations to understand how their investments are performing. Financial statements properly prepared and diligently analyzed facilitate these decisions. This chapter is initially concerned with financial statements and depreciation. Then we progress to the study of a firm's financial statements through ratio analysis. Management may use the analysis as a planning device, a tool for control, or a means to identify weaknesses in the firm. General accounting principles. To be useful in decision making, financial statements must be first relevant, reliable, which is verifiable and comparable, neutral, and complete. For information to be relevant, it needs to report about past events or facilitate decision making in the present to benefit the future. Information is timely if it is available to decision makers before its usefulness decays. Consider a company that decides to spend money to move its factory to a place where labor costs are lower in order to increase the firm's profitability. If management does not measure the costs of moving or the benefits of the lower costs until 10 years after moving, then it will not be known in a timely fashion whether the move was wise or not. Information is reliable if it is verifiable and comparable. Verifiability means that the information can be consistently measured by a group of independent measurers who will come to the same or very similar answer. For example, the amount of cash in a cash register can be verified because multiple honest people can count the money and come to the same answer. Information is more useful if it can be meaningfully compared to another enterprise's information for the same period. For example, Coke and Pepsi, they are competitors, and they're both in the soft drink industry. And so investors would want to be able to comfortably look at Pepsi and Coca-Cola to be able to compare their profitability. However, if Pepsi and Coke aren't doing similar accounting principles and one's doing something completely different, then it can skew the numbers one way or the other. Neutral. Neutrality means that the information is not skewed to be positive or negative. Like a baseball umpire, the financial statements should simply report the facts in an unbiased way that is not intended to lead the reader to a desired result or favor one side or view over the other. And then they should be complete so that they do not mislead the reader, and so everything should be done in a timely manner and completed. Providing financial statements that are relevant, reliable is a noble goal. However, there are limitations. We now shift to the balance sheet. The balance sheet represents what a firm owns, which is its assets, what it owes, its liabilities, what owners have invested in a firm, its equity at a certain point in time. So when we look at the balance sheet, we are looking, and usually these will come out a lot, at the end of the fiscal year. And so one of the things to remember is that companies do their fiscal year at different times. So balance sheets can come out at different times and at different paces. A consolidated balance sheet is a parent company's balance sheet which summarizes and combines the balance sheets of the firm's various subsidiaries. Assets. Current assets are cash and cash equivalents, accounts receivable, and inventory. So, the current assets of a business include all of its cash and cash equivalents that it has on hand. Its accounts receivables, which is money that they anticipate to receive from people that may owe them in the short term, and then inventory that they have on hand. Non-current assets are assets that are expected to be held for more than 1 year, such as land, buildings, and machinery. Then there's also hidden assets. Now, one of the things that when we look at this, um, uh, hidden assets can be a lot of different things. Um, you know, a company may report when they buy a specific piece of land, they may report that land as being X number as a certain value, and they'll report it at what level they bought it at. And so they will often list the value of the land as the purchase price. Now we know that land typically appreciates, and so that company may have land that they bought for $100,000. Well, that land may actually now be worth $200,000, and that would be considered a hidden asset. And then there's also goodwill and intangible assets. And when we look at these, you know, uh, intangible assets are things like patents, trademarks, copyrights that have value, just like land, buildings, and equipment. Another example of a hidden asset is, the Coca-Cola secret recipe and trademark. Uh, you know, that formula that Coke has, they, that's a hidden asset because if you, a lot of you may not will not remember this and may have never even heard of this, but Coca-Cola at one time decided to change its formula and change its Coke product. And there was extreme backlash, and in less than 3 months they had changed it back to the original formula because there was so much backlash from the public. So that is a hidden asset as well. Liabilities. A current liability is an obligation that must be paid within 1 year. Accounts payable, notes payable, accruals. So again, when we are looking at liabilities, a current liability is something that has to be paid within 1 year. So let's say that you have um, some suppliers that you owe some money to, and that has to be paid within a year. That would be considered a current liability. Long-term liability, however, is an obligation that becomes due after 1 year. So such as you've purchased uh, um, you've got a lease on land, or you've got a lease on equipment, but that lease doesn't come due, and you're making pay, and it doesn't come due for 5 years. That would be considered a long-term liability. Stockholders' equity. Book value, which is equity, which is comprised of preferred stock, common stock, additional paid-in capital, and retained earnings. Book value per share is the book value divided by the number of shares outstanding. So, if to kind of help make sense of this, when we're looking at book value per share, let's say that the equity is $2 million, and there is 1 million outstanding shares. our book value per share would be 2. And so you take your book value and you divide it by the number of shares that you have outstanding, the number of shares of stock that's been issued by the company. So now we begin to look at the income statement. The income statement tells investors how much accounting income or profits the company has earned during a period of time. For example, its fiscal year. It's a summary of revenues and expenses and indicates the firm's accounting profits or losses. It is not, however, a summary of cash receipts and disbursements. Receipts and disbursements are considered in the cash budget, which is discussed later in Chapter 24. And so it determines income, and it also helps determine earnings per share. Statement of cash flows. Accountants, financial managers, and investors have increased their emphasis on analyzing a firm's ability to generate cash. So the statement of cash flows is divided into 3 sections: operating activities, investment activities, and financing activities. In each section, it enumerates the inflow and outflow of cash. So it gives us sources of funds, which is cash inflows, and then how those funds are used, cash outflows. It determines change in the cash position, and the emphasis is on the firm's ability to generate cash. Cash inflows are a decrease in an asset, an increase in a liability, and an increase in an equity. The cash outflows are an increase in an asset, decrease in a liability, and a decrease in equity. So as cash comes in, you may have sold an asset, so that creates a decrease in that asset. But it creates an increase in a liability and an increase in the equity. Whereas when cash is flowed out, you may have purchased an asset. So now there's an increase in the asset, but a decrease in liability and a decrease in equity. There are limitations of accounting data. And one of them is non-measurable items are excluded from the data. And then there's also aggregations. And so what we've got to understand is that accounting statements that are available to the public give aggregate data. Although the company's management has access to itemized data, individual investors or security analysts may not receive sufficiently detailed information to guide investment decisions. For example, a company may not give its sales figures according to product lines. Aggregate sales data may not inform the public as to which of the company's products are its primary sources of revenue. And then there's possible biased estimates of data. For example, the valuation of assets by the lower of either cost or market value may result in a biased information if the dollar value of the assets has significantly risen, as may occur during periods of inflation. Such increases in value are hidden by the use of the historical cost, and thus accounting statements do not give a true indication of the current value of the firm's assets. Then finally, insufficient challenges by auditors. The accounting statements of publicly held firms must be audited by an independent certified public accountant, or a CPA. These audits, which are an official examination of accounts, must be performed annually. After conducting an audit, the CPA issues an auditor's opinion that attests to the fairness of the financial statements and their conformity with GAAP. By fairness, accountants mean that the statements are not misleading. The the auditor's opinion must be included in the firm's annual report. On occasion, the opinion may include a discussion of specific factors that affect specific details in the financial statements. In this case, the opinion is said to be qualified. We now turn our attention to depreciation. Depreciation was previously defined as the allocation of the cost of a tangible asset such as plant or equipment over a period of time. It is a non-cash expense and it has impact on taxes and cash flow. Our text talks about straight line and accelerated depreciation. Straight line depreciation is equal allocation each year. Accelerated depreciation is where a larger proportion during the early years and then a lesser proportion during the latter years. Straight line depreciation example. If a firm anticipates that a $400 machine will have a useful life of 4 years, the firm does not expense the $400 immediately on the income statement. Instead, the firm capitalizes the asset on the balance sheet and then depreciates the machine on a straight line basis for $100 a year. So the annual depreciation equals cost divided by anticipated useful life in years. So it costs $400. They believe it's going to last for 4 years. So it's a depreciation of $100 per year, and that's how they report that on the balance sheet. Accelerated depreciation, however, is depreciation charges are larger when the plant and equipment are new and smaller when the plant and equipment are old. Modified Accelerated Cost Recovery System, or MACRS, is a type of accelerated depreciation that became law under the tax revision of 1981 and that was revised under the 1986 Tax Reform Act. Exhibit 9.4 shows us the depreciation schedules under a modified accelerated cost recovery system. So you can see there, for example, 3 years, they do 33%, 45%, and then 15 and 7. And you can see there over in the last column there, the 20 years, they start at 3.79%, then 7.22% in year 2, and then year 21, it's down to 2.25%. Differences relate to their effects on the firm's earnings and effects on the firm's taxes and the cash flow from the investments. The accelerated method of depreciation increases the firm's income and taxes and reduces its cash flow in the later years of the asset's life. The advantage is in the timing of the taxes and the cash flows. So the question becomes, if accelerated depreciation does not reduce the firm's taxes and increase its cash flow over the life of the asset, what's the advantage? So if you remember from our discussion in Chapter 7, it is better to receive cash flows sooner than later, and it's better to pay cash flows out later than sooner. So accelerated depreciation increases the firm's after-tax cash flow during the early years of the asset's life and delays the payment of taxes until the later years of the asset's life. Accelerated depreciation increases the cash flow now so that the firm has the cash to invest and increase earnings. What is the rate or amount by which an asset may be depreciated each year? Under straight line depreciation, the same dollar amount is subtracted from revenues each year. Under accelerated depreciation, the initial cost of the investment is reduced more rapidly because larger dollar amounts are subtracted during the early years of an investment's life. Ratio analysis of financial statements. Accounting data are often used to analyze a firm's financial condition. Such analysis may be conducted by creditors to measure the safety of their loans. Investors also analyze financial statements to learn how well management is performing. The profitability of the firm may be perceived in the financial statements. In addition, management analyzes the data in the financial statements to identify weaknesses in the firm, which, if corrected, may increase the firm's profitability and value. The ratios used in financial analysis can be classified into the following groups: liquidity, activity or asset utilization, third, profitability, fourth, leverage, and fifth, coverage. So ratio analysis of financial statements, it builds on a firm's financial statements. They're easier to understand and they're used by both investors and creditors. Liquidity ratios measure the capacity of the firm to meet its current obligations as they come due. Activity or asset utilization ratios indicate how rapidly assets flow through the firm and how many assets are used to generate sales. Profitability ratios measure performance. Leverage ratios indicate the use of debt financing, and then coverage ratios measure the capacity of the firm to make certain payments, such as interest. Ratio analysis facilitates comparisons over time or compared with other firms within the industry. Comparisons should help the analyst determine the firm's position within the industry as well as trends. Time series analysis is analysis of a firm over a period of time. Cross-sectional analysis is the analysis of several firms in the same industry at a specific point in time. Liquidity ratios. Ratio of current assets to current liabilities. Measure of liquidity is current ratio equals current assets over current liabilities. It indicates how well the current liabilities, which must be paid within a year, are covered. In our textbook, it talks about Matilda's Flower Shop, and it gives an example that their current assets are $3,102,306. Current liabilities are $2,062,846, and the current ratio is 1.5. This indicates that for every dollar the firm must pay within the year, there's $1.50 in an asset that is either cash or should become cash within the year. For most industries, it is desirable to have more current assets than current liabilities. In fact, in some, it is desirable to have at least $2 in current assets for every dollar in current liabilities, or a ratio of 2 to 1. The quick ratio or acid test. It's a variation on the current ratio. It's a measure of liquidity. Its quick ratio equals current assets minus inventory divided by current liabilities. Although the current ratio gives an indication of the ability of the firm to meet its current liabilities as they come due, that ratio does have limitations. It is an aggregation of all current assets and does not differentiate between current assets with regard to their degrees of liquidity or how quickly they can be changed or move into cash. The ratio considers inventory that may be sold after 3 months on credit and then payment for which may not get collected for an additional several months. So that's why we use the quick ratio or acid test. For Matilda's Flower Shop in our textbook, it would have a quick ratio of 0.90, which is lower than the current ratio of 1.5 determined previously. The difference, of course, is the result of inventory that the company is carrying. A low quick ratio indicates that the firm may have difficulty in meeting its obligations as they come due. The quick ratio, however, does not indicate that the firm will fail to pay. So keep that in mind. The components of current assets. Rank the current assets with regard to their degree of liquidity and determine each one's proportion of current assets. So the table indicates that 17.1% of the firm's assets are cash and short-term securities. And inventory accounts for 39.9% of current assets. Since this technique determines each asset's proportion of current assets, it gives an indication to the degree of liquidity of the firm's current assets. If a large proportion of the current assets is in inventory, the firm is not very liquid. So remember that. If a large proportion of current assets is inventory, the firm does not have good liquidity. And so you would want a greater percentage in those other categories, because if inventory is greater, again, you may not be able to sell that inventory off as quickly as you would like, and it would take longer to convert into cash. Activity ratios. The speed with which inventory is sold. The more rapidly the firm turns over its inventory and receivables, the more rapidly it acquires cash. Hence, high turnover indicates that the firm is rapidly receiving cash and is more able to pay its liabilities as they come due. High turnover, however, does not necessarily imply that the firm is maximizing profits. For example, high inventory turnover may indicate that the firm is selling items for a lower price to induce quicker sales. If they sell at a lower price, it's going to ultimately reduce profits. So inventory turnover equals sales divided by average inventory. Receivables turnover is defined as annual credit sales divided by receivables, since only sales on credit, not cash sales, results in accounts receivable. Thus, the receivables turnover ratio is expressed as receivables turnover equals annual credit sales divided by the average accounts receivable. An alternative definition substitutes annual sales for annual credit sales, and so in that situation it would be annual total sales divided by average accounts receivable. Or day sales outstanding equals average receivables and sales per day. Fixed asset and total asset turnover. Fixed asset turnover is a measure of fixed assets necessary to generate sales. So the fixed asset turnover formula would be fixed asset turnover equals annual sales divided by average fixed assets. Total asset turnover is a measure of the total assets required to generate sales, and that's annual sales divided by average total assets. And then we begin looking at our profitability ratios. Profitability ratios are measures of performance that indicate what the firm is earning on its sales, its assets, or its equity. The words profit, income, and earnings are often synonymous. So operating profit margin equals earnings before interest and taxes, or in the book you can also see it referred to as EBIT, divided by sales. Net profit margin equals earnings after interest and taxes divided by sales. Operating cash flow margin is earning before interest and taxes divided by sales, and then gross profit margin equals revenues minus cost of goods sold divided by sales. Other profitability ratios: return on equity, earnings equals earnings after interest and taxes divided by average equity. Return on total assets, earnings before interest and taxes times 1 minus the tax rate over average total assets. And then basic earnings power is earnings before income and taxes divided by total assets. Leverage ratios. Among the more frequently computed ratios are leverage ratios, which measure the firm's use of debt financing. The two most commonly used ratios to measure financial leverage are: one, debt to equity, which is often referred to as the debt over net worth ratio, and then secondly, debt to total assets, which is commonly referred to as the debt ratio. The debt to equity ratio, so let's say, for example, that the debt to equity ratio is 3.23. That would indicate that $3.23, there is $3.23 of debt for every dollar of equity. The debt to assets ratio, if you do that calculation and it comes to 52.7%, indicates that debt is financing 52.7% of the firm's assets. Now, leverage ratios are not only an indication of risk to creditors, but also of risks to stockholders. For firms that are highly financially leveraged, they are riskier equity investments. You can see here Exhibit 9.6. The ratios differ depending on the formula. For example, some financial analysts compare debt or liabilities to total capital rather than total assets. Total capital is defined as interest-bearing debt plus equity. Interest-bearing debt excludes accruals, payables, and other operating liabilities. It is sufficient for now to suggest that finding the optimal use of financial leverage may benefit common stockholder by increasing the per share earnings of the company and permitting faster growth and larger dividends. If, however, the firm is too financially leveraged or undercapitalized, potential investors may be less willing to invest, and creditors will require a higher interest rate to compensate them for the increased risk. Thus, leverage ratios, which measure the use of financial leverage by the firm, are among the most important ratios that managers, creditors, and investors may calculate. The DuPont system of financial analysis was designed by that firm's management to measure a firm's earning power. The system shows the return on equity as a product of its components: net profit margin, total asset turnover, and leverage. Essentially, the DuPont system determines the return on equity by multiplying three things: the net profit margin, total asset turnover, and thirdly, an equity multiplier used to indicate the amount of leverage. Coverage ratios. In addition to the ratios that we've just talked about, Uh, some financial analysts may compute coverage ratios, which indicate the ability of the firm to service or cover some payments such as interest. So times interest earned equals earnings before interest and taxes, and then annual interest charges. A ratio of 2 would indicate that the firm has $2 in operating income for every dollar in interest expense. The higher the numerical value of the ratio, the safer the interest payment. So that brings us to here, analysis of financial statements and the internet. Now, we've talked a lot about, there's a lot of formulas that we've talked about, a lot of computations that would need to be done if you were to sit down and look at this and try to do it yourself. A set of ratios by themselves has little meaning. There has to be some type of comparison. And so, comparisons of ratios of firms within an industry, for example, you may want to, we go back to Coke and Pepsi if you want to compare their ratios to kind of get an idea of which you would prefer to invest in. Now, the alternative is to use the internet. Instead of sitting down and doing all of these calculations yourself, there are paid resources such as Bloomberg, S&P Capital, IQ, and then there's also free information that you can get, sources such as Yahoo. If you go to finance.yahoo.com and Koifin.com, you can enter the company's ticker symbol and start the search, and it will bring you to those ratios. They are readily available data that they may differ depending on who's doing the calculations, but some of that can be differences in time periods covered, differences in ratio definitions, etc. But again, that information is there and is easily available. When would the use of some ratios be more important than others? Financial leverage ratios are important if a firm has borrowed too much in the past. Activity ratios are important if a firm has expanded quickly, now finds itself with excess inventory and manufacturing capacity. Profitability ratios are always important, and the DuPont system allows or shows the return on equity as the product of its components: net profit margin, total asset turnover, and leverage. This concludes our discussion of Chapter 9. Make sure that you watch both Chapter 8 and Chapter 9 PowerPoint lectures, and then make sure you also watch any additional videos that I may post under a Week 5 module. Don't forget, your topic report is due by Sunday at 11:55 p.m. Thank you and have a blessed week.